We're going to look at Big 5 Sporting Goods, and this is a specialty retail store, and what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I also look at the financial ratios of the company and compare them with its competitors. And I'm going to do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $96.3 million. And let's see what they're trading at. It's $4.41 a share. Let's get the free cash flow. And the way you value a company is you estimate the future free cash flows, then discount that number back to today. That's exactly what I'm doing in this video. Now I'm pulling the net income, which is the profit and loss for the company. Now I'm going to pull the revenue, which are the sales for each year. So it looks like their revenue has been decreasing every year, and their free cash flow net income is kind of all over the place. So it may be a little difficult to value this company, but let's see what we get. Let's look at the capital structure so we know what discount rate to apply to the future cash flows. So the interest they pay on their debt is $3 million. Let's go to the balance sheet to see how much debt they have. We'll go to the liability section. And no current debt. They have $66 million of long-term debt. That's debt due after 12 months. They pay 4.5% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. We'll go back to the income statement. Their income before tax is $12 million. Their income tax is $3 million. So their effective tax rate is 28%, and that means that cost of debt is 3.3%. Now to get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. And they have a beta of 1.67, so the stock is a little more volatile than the market. And the more volatile the stock is, the greater the risk of the stock and the higher the weighted average cost of capital. Let's go back to the balance sheet to get their current assets. And we need the current assets to calculate the current ratio later. Current ratio is current assets over current liabilities. And that's $340 million. And let's get their current liabilities. These are debts and payables which are due within 12 months. That's $222 million. Let's get their equity. That's $180 million. Equity is assets minus liabilities. We also need their EBIT, earnings before interest and taxes. That's on the income statement. That's $14.8 million. Let's look at the capital structure. The cost of debt is 3.3% and the weight of debt is 27%. The cost of equity is 15% and the weight of equity is 73%. So their WACC is 12%. And that's a blend of the cost of debt and cost of equity. That's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. That's $239 million. We discounted those numbers back to today's value using the weighted average cost of capital, and we get a value of the company of $332 million. We divide that by 22 million shares, and we get an intrinsic stock price of $15.22. It's trading at $4.41, so it's trading at a 71% discount. So it's definitely a buy according to the model. Simply Wall Street does not have a value for this company. And my other models didn't come up with a value. There's only one model that I could actually get a value for this company. So it's really hard to value companies that have inconsistent financials. Let's look at the historical stock price to see where the stock has been trading. The stock was trading about $20 a few years back, but it's been dropping ever since. I think there's concern with this company that it may go bankrupt, but if they can get through coronavirus, they may be okay. Let's look at their financial ratios. They have a good PE, that's price of stock over earnings per share. Earnings per share is net income over shares outstanding. So under 15 is considered good. That's a great price to sales ratio of 0.1. That's price of stock over sales per share. And to get sales per share, it's revenue over shares outstanding. That means investors are willing to pay 10 cents for $1 of sales. A price of sales under 1 is considered a great value. They also have a good price to book ratio of 0.5. That's price of stock over book value per share. To get book value, it's equity over shares outstanding. This indicates that if the company went bankrupt, liquidated its assets, paid off all its liabilities, it would have enough to give each shareholder $8.26. And when your shares are worth $4.41, that's a pretty nice return. They have a good current ratio of 1.5. That's current assets, $341 million, over current liabilities, $223 million. They have a bad ROE. That's net income of $8 million over equity of $180 million. I like to see at least 20% when I invest in a company. They have a good interest coverage ratio of 4.9. That's EBIT over interest expense. So the company looks okay, but you want to look at their more current financials to see if these ratios are getting better or getting worse. I have a feeling they're probably getting a lot worse. The best way to look at ratios is to compare them to similar companies. I've done videos of Canadian Tire, Office Depot, and Williams-Sonoma, and all these companies are in the same industry as Big Five. And Big Five has a better than average price to earnings, and they have the best price to sales and best price to book of the 4 companies. They have a good current ratio. They're much worse than the average in ROE. They're better than the average in debt, and they're by far the smallest company of the 4. So it could be a risky play, Big Five, but bigger risk, bigger reward, right? Let me know what you think in the comments. Thanks for watching.